believe me, don't believe me. Human nature doesn't change. You've got a record level of fraud. And I think that Chanos will eventually be, I feel virtually certain that he's going to be proven correct, that this will be looked back as the golden age of fraud.
Yep.
And here's the thing. When the tide does go out, there's going to be people and companies wrapped up in this fraud that nobody saw coming.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots, and I am joined as always by the brain trust himself, Mr. Chase Taylor. Two things that I was going to start with that I'm sure on top of everybody's mind was the University of Houston's football season.
3-0.
There we go. I knew he just had to get that in there.
And we're off this week, which means we're not going to lose this week.
How are the Browns?
We don't have to talk about that.
They lose again.
Oh, we got killed.
Okay.
Yeah.
By who?
Baltimore. At Baltimore.
Yeah,
and we had we started turning the ball over. We had our 8th string cornerback in who couldn't cover anybody. And we were like, let's let him play some man coverage. And that didn't go his way. He got beat for 3 touchdowns.
Yeah, that's not good. When you got a receiver for Baltimore that drops 3 touchdowns on you, that's probably not going to end well.
Yeah.
Because
it was not a good showing.
Yeah, because if that dude's got 3 touchdowns, the next question is, well, Lamar and Derek had to do something.
But Derek did nothing, actually.
Really?
We bottled him up.
Wow.
If you saw the score, you'd been like, oh, Derrick Henry must have had a good game. No, we shut him down completely.
Wow. Okay.
But, they had a fumble recovery for a touchdown.
Okay. Well, so the other one that I'm sure just for everybody knows, our 5th grade team won again.
Boom.
They had to stop the game with 6 minutes left to go in the third quarter. God bless these kids. I felt bad for the other team, but we got a pretty physical bunch, and they didn't have enough kids to finish the game. So
shouldn't laugh.
No, I know. I felt horrible for the kid. I felt horrible for the kids, and our kids do not play. It wasn't a dirty thing. It's just they play.
Football.
Yeah, it's football. It's a tough game. So, but 2-0. I felt like a jerk though, but I had to do it because we quit the game early. We had to run gassers.
Exactly. Syracuse did that. I was talking about we did that in high school after every win, but Syracuse just did it. They beat somebody, and the coach didn't like the way they played and made them line up and run.
I love it. Yeah, yeah.
Anyway. Get your work in.
You got to get your work in, right? That's just life. Anyway, markets. The other thing that we were talking about before we came on is you love it because there's two sides. Obviously, there's 2 sides to the investing coin, right? There's times when you're making money, and there's times when you're not. And when you're making money, it is infinitely better than the times when you're not. Yet at the same time, there are these times where it feels like it's coming too quick and too easy.
Exactly.
We're up now just inches away from 30% on the year, and up another 1.1% today. And it's starting to freak me out a little.
It's starting to freak me out a lot. I think it was starting to freak me out a little 2 weeks ago.
And the other thing too is in times like these, I've learned that you don't get a lot of these. The last time I had a year like this was like 2021, where all your themes were playing out like you thought they would. Your biggest position is outperforming the market. Your smaller, you know what I mean? It's all clicking on all cylinders. I think there's 2 ways to look at that situation. You either think that you're really that good and you're really that smart, or you sit there and go, I'm not really that good and not really that smart, but sometimes things roll my way and I need to take some money off the table. That's kind of what it's feeling like. I don't want to change the way we're positioned because I still very much believe fundamentally in our positioning. It's just not supposed to happen this fast. You know what I mean? It's just too much too early is what it feels like.
Like I said, too easy. Anytime in the market, things feel too easy. In my, oh man, what is this now? 17 years. Yeah. 17 years investing. Every time I started feeling too easy, I started thinking I was pretty good at it. The market turned around and basically gave me a P&L wedgie. So
yeah, well, and here's another way to look at it. is when things look too easy or when things feel like that, the only thing you need to worry about is the risk. You know what I mean? So that's one of the things I've learned is that one of the way, don't do that. Don't believe you've figured out or you've cracked some new code. Be only worried about the risk from that point on.
To me, you just start looking in the bushes that much harder for something ready to jump out and get you.
Right.
It probably is lurking and ready to do exactly that.
Yep. And when the bushes get too big, you got to trim them. Right. So, but it is getting a little bit unnerving. The other reason it's getting unnerving is, and anytime things get expensive, you should be concerned. But it just increasingly every single day, it feels like the market is just getting more and more and more detached from economic fundamentals. It doesn't even really react to them anymore. You know what I mean? It's kind of like its own game played by its own. And there's all the reasons that we've talked about 8 million times. But it is, and not across the board. I mean, I think there's certain things like we were talking about that make more sense right now than they did 3 years ago, than they did even 5 years ago. The flip side is simultaneously there's stuff that makes even less sense, right? Like, for instance, now we've seen this company and we've talked about it a lot, but I'll keep bringing it up. Tesla's multiple expansion in the face of this news in this market. I've never seen anything like it. Like, I disagree with investors, but they're literally bidding this thing up on news that is bad for Tesla.
Well, today Elon bought $1 billion in equity, and that fired the market up. $1 billion.
$1 million.
Billion.
$1 billion.
But I mean, that's, so it got however much that was in market cap, however many tens of billions.
Why would he?
To
juice the stock,
to make people get excited. I think he very much took personally that Larry Ellison jumped him as the richest guy in the world there for a day or two. And I think he started trying to. He saw Larry run a pump, so he had to respond in kind.
Because I'm just looking at that and going, why don't you sell stock here?
Well, you might be doing that before too long, but
why would you be buying it here?
Yeah.
At that multiple on that chart, I mean, right. What are we talking about?
That's why he did $1 billion and not 30 billion, right?
Yeah,
if I could get that kind of return on $1 billion, I would do it too.
Well, I don't even understand the narrative anymore. Right? Like what
there isn't one.
You're buying that for where is $1.4 trillion of value in that company? Well, Elon's going to do this. Elon's going to do. I'm still waiting for the Roadster, man.
I mean,
where's the semi truck?
Yeah,
the best full self-driving robo-taxi, all that. Like, I'm like, and I think my view on Elon has changed. I used to think he was an out-and-out fraudster. I don't think that anymore. And I could be wrong, but I don't think that. It's just the whole thing is just a head scratcher to me. I don't get it. I just don't understand it.
Yeah, I don't think we ever will.
If you're buying that company at 1.35 or 1.4 trillion or whatever it is, what are you buying? Explain to me what it is that you're paying that price for.
I mean, you're just being a fan that's buying a ticket at the end of the day. It's not because you think the value of the actual underlying business is going to go up. You just think other people will buy it from you later at a higher price.
I mean, like at $500 to $600 billion, that thing is nosebleed expensive. But seeing as though it's Elon Musk, I mean, mathematically, I could sit there and see how an investor could make money at that level. At one point, I don't.
It's its own class of investment. There's all there's to it.
Yeah,
and we see other things come and go. Like CoreWeave just kind of like flew in there and then went away, and like you see all these kinds of things happen. But Tesla's been doing it for a long time.
Yeah,
it's just its own thing.
Yeah, it's pretty unique. Yeah, wild. Google continues to get re-rated in a move that I'm happy about.
I will say I think that the antitrust case was weighing on it more than I think we even realized. If you kind of look at the chart, it just unleashed. From that point.
I didn't think it would be weighing on it that much. The reason I didn't think, I think that's clear.
Yeah.
But it also reinforces what we've been saying about markets being inefficient. they were still trying to value Chrome at zero. And even if the government, quote unquote, busted them up and made them divest, they're not giving it away. It still didn't. I mean, hey, it's why value investing works.
Maybe some people are pricing in much worse than just divesting of Chrome, of getting smashed on the search side and stuff too. I don't know.
Yeah.
I mean, never mind the fact that, antitrust regulators in America haven't really done anything in 30 years.
Yeah,
apparently they thought they were coming for this one.
Yeah, I didn't think that they were the worst as far as that goes. Meaning, I think that other companies are more monopolistic. They certainly are too.
100%, no doubt.
Yep, that's why they're successful. It's like Warren Buffett loves to buy monopolies if he can buy them. But I thought there were other companies that had much stronger antitrust cases against them.
Rip through the markets?
Yeah, let's do it. Yeah, let's talk indexes here.
So S&P up another about basically 0.5%. Q's up 0.86. Small caps up 0.4. Equal weight down on the day 0.17. So it's kind of notable. Equal weight hasn't made a new high in the last month. I think it's a little under the radar. This is very cap weighted dominance lately. Mag 7 up 1.9 with equal weight down. Every time people count out Mag 7 versus equal weight, it just tears its face off.
Well, recently that's just all been driven by Google and Google Tesla recently. Yep. I mean, that's everything else has pretty much stayed there, but you see it dragging Apple's price further up too, and that one's people are gonna lose some money on Apple.
Another day of outperformance in the rest of the world with the all world ex-US up 0.76, so another whatever that is, 29 basis points of outperformance from the rest of the world. And I just keep picturing the S&P is the skinny guy flexing, and then there's this monster in the background that's the rest of the world flexing, and it's just way bigger.
Yeah. And
you just get this feeling these US investors that are all in on US keep thinking they're winning, and then you look and on a relative basis it's not good.
Oh, they're getting throttled.
China's up almost 50% on the year, dollar down 0.3, another that's why a lot of this is happening. Oil up about 1%, still in the 63 area. Gold up 0.94, silver up 0.8, gold miners up another 1%.
Is that a new closing high for gold?
I think so. Yep.
I continue to be blown away that we've made. If you would have told me we'd get to 3,700 on gold without ever seriously retesting 3,000, I wouldn't have believed it.
Speaking of the whole just getting uncomfortable thing, things coming easy, I think it's part of it is a lot of things we own, not only have they done well, but there haven't been any shakeouts, which is uncomfortable. Because normally, even in a really good bull market, you run up and then you shake people out by going down for a few weeks or whatever. A lot of the assets that are having good years this year don't even have moves to press people out. 2-year down about 3 basis points, same for the 10-year. So yields keep coming down. One of the most interesting things going forward now is going to be, hey, you have the 10-year at 4% now. How much help does that provide real estate? Does it help real estate really recover and start getting back on its feet? Or is real estate's kind of so far gone, even at a 5.9 or whatever we're at percent mortgage, that we just still that may be the whole do we have a recession or not question comes down to, I don't know, how much is housing bounce with these rates? Google up 4.5 today, Tesla up about 3.5. It was up 8%, I think, before the market opened. So it kind of did fade intraday. This is one we like to highlight often. Market up, vol up one day. So kind of notable. The September VIX contract up about 1%. So on an up 0.5% day, it's only one day, but if that happens another couple of times, you get that cluster of vol up.
Well, wasn't spot up 6?
Yep, 6, and you're still at a 15 handle, even with that 6% jump on spot VIX.
I don't like that. I saw that today. That has always been an alarm bell.
Yep.
Now we've referenced it a couple other times, but the other times that we referenced it, it was up 2 or 3%. That's not enough to catch my eye.
And usually it's a cluster of 2, 3, 4 days where it's curiously not going down. And usually all it is just from my perspective, a few smart people getting out there to buy it up to hedge. It's not But I will say, like, if you look at the flows into VIX, like they have been pretty heavy. So like there are enough nervous people out there lately. It just, it's just been a terrible trade for people, but those flows have been there. China up another about 0.7 today, so another day of outperformance there.
Alibaba's ripping.
Yeah, that's straight up again. Another thing just going straight up to the point where it's not comfortable.
God, I feel like we just bought that at like 85.
Yeah,
Didn't we?
It was just it was one of those things, like the chart was just so good and made it so easy. No, we bought it around like 120, I think.
Yeah, but well,
because you're at 158 now.
We took different stabs at it.
So
we wrote it one time. We bought it one time, wrote it up. We didn't get a lot on it, but I think we wrote it. We made a purchase at one point at some point in the 80s. And then I think we sold it like on an 8 or 9% gain. We didn't like the look of the chart or something like that. So that's where we picked up this last round, but we'd made some money on it on its way up to that.
It made such a perfect little like downtrend line breakout at around 120. It made for a nice kind of just risk reward shot, and every once in a while they work.
Yep. Yeah, Google continues to just parade higher. It's the one. I mean, you're always buying stocks because you want them to go up, but yeah, it just gets and it's just a fact, right? Every dollar it goes higher, that's another dollar you're risking, give back, and it's just.
And to go back to football, you think about a coach like Bill Belichick. If he wins a game 42-0, he probably gets more anxiety from that because he knows how difficult it is to get everyone motivated that next week and to like focus hard on the flaws and everything. It's similar to investing. Like, things are going great. Like it can be uncomfortable.
Yeah. Yeah. Well, and it's such a weird time, especially in a time like this, because that so many things underneath the surface are not going well, right? Like that's what makes you so nervous, is not if something bad happens. You're literally sitting there saying a really bad event could be this market just pricing in reality.
So we could have sort of a buy the rumor, sell the news thing on the Fed. They're going to cut rates Wednesday. The market's obviously been excited about the fact that we're going to get some rate cuts.
What are we pricing in?
Just right at definitely going to do a 25 basis point.
That's what
There's
thought.
Like a 2% chance of a 50 basis point.
So we're showing like what, a 29% or 29 basis point cut?
Yeah.
Oh, 26.
Yeah, I mean,
okay.
You're pretty firm there.
Okay.
So we actually jumped to, I think, 117. I can't remember if I covered this on the show or not, but on Thursday we had the jobless claims come in, and initial jobless claims spiked. And like a lot of people were like, whoa, like yields really sold off. But it was like, you look at the state by state and it was like, okay, it's one state. It was Texas. And then not too long after, they were like, yeah, we just had a flood of fraudulent claims. So it was like instantly like, never mind, like no need to worry about the jobless claims. Right. That was just nonsense.
Okay.
And I think that helped pull you back from like the 117 back to, okay, we're only going to do 25.
Okay. I'm trying to think of some other international.
So one thing that comes straight to mind. There was an auto lender, subprime lender in Texas that just
Trichlor
went bankrupt. And what's interesting about it is the paper that they were selling was valued like it's great, like AAA, like great stuff. Like close to 100 cents on the dollar kind of stuff.
Carvana.
So the fact that like they got smoked on, despite it just has that like weird vibe to it. Like,
well, and that's another thing that makes you nervous. And I think that what has prevented any of that happening is, if you look at liquidity, there are natural flows to liquidity, like there's natural flows to rivers, right? I honestly believe in time we will see that one of the unintended consequences of the Fed activity, thinking that they just need to keep liquidity wide open all the time now, because that's basically what they think, is that it's liquidity crunches that unveil a lot of fraud, right? And when you will not let a liquidity crunch happen, you're stacking up fraud. When the tide finally does recede this time, I think you're going to be sitting on a record number of frauds. And I think there's proof.
And just some of it's not fraud; it's just bad lending.
Yeah,
and
but remember, that's the old adage: like a rolling loan gathers, there's no loss. right? Just because as long as you can keep flipping it. And
I know, I think it's on Forward Guidance. They did an interview with a guy who follows, all he does is look at banks and credit stuff. And he made the point that the amount of loans that are just getting rolled and what I'm trying to think of the technical word for just the extend and pretend stuff they do with those is was just jumping off the map, like crazy amounts of that.
Well,
we talked about it specifically with Carvana, but apparently it's happening at all levels of credit.
It's private equity, right? Because
but literal banks too.
Yeah.
So actually, the regulated banks are doing it.
Yeah, but and this is why you get these environments where nobody has an incentive to write it down.
Truly, right?
Nobody does.
Yeah.
And so when you're sitting there going, okay, if we hold to the tenets of this law, I'm not the tenets. What do you call the rules of a loan? I'm blanking.
I know the word I'm searching for,
but if we stick to all those rules, okay, they're done, they're smoked, and all the debt that we have sold of theirs to our clients is smoked. Our clients are smoked, we're smoked, they're smoked, or we could refinance them.
Right, exactly.
Even though we know they can't pay it back.
Yeah, just pay us 80% of what you're going to pay us. If just whatever they can pay, you just take it.
Yeah, and guys, that's that's not new. That's been happening all over the place. It's spreading though, like you said, in other banks. But private equity, this was going on for years, and I'll explain how it happens. Right. So, private equity company goes in, they get some investors to sell their stuff. Right. Well, demand for their shares goes up to the point where those private equity the guys that own the company are sitting there going, well, we need some more capital, but we're not willing to sell you equity. We'll do a debt deal with you, right? Because they feel like they can command that. And 2 years later, that growth trajectory they were forecasting hasn't really hit, and the cash flow isn't there. And they go back to lenders and go, we need some more money. Lenders go, no way, we're cutting you off. And they go, okay, well, then you're going to have a zero. We're to default on loan. And lender goes, whoa, hold on. I don't want to take a zero on my books. Let's refinance. Right. So for people out there not thinking, well, what do you mean? Nobody's just going to lend them money. Yeah, because the lenders are the investors, right? They don't want to take markdowns. And when you run a private equity book, and in some cases, 30 to 40% of your book is in this situation, you can't have them write it down, right? Like you can't.
Yeah, both sides lose. So
yeah,
the incentives are pretty clear.
Yeah. And so they'll just keep rolling it and hoping that somebody changes, right?
And that's where if you get a real liquidity problem, then that little game that you're playing is all of a sudden up.
Yeah, that game is hot potato
how about
right
you pay
now.
us 50%? Like, no, we can't pay you anything.
Yeah,
and then you have to market, and then the market's like, whoa, like what do you mean you have a bunch of defaults? Your delinquency rate was like nothing last month. I'm like, cool, yeah, but that's because it was delinquent, but we didn't call it that. We called it, we refied them at 80% of their old payment. And
again, I don't think it's hyperbolic at all to say, like, I actually think that you're really naive if you don't think that there's a record number of those kinds of problems underlying this. And people be like, Zach, why are you so sure of that? I'm sure of that because it's the longest economic expansion in history that has been provided with the most insane amounts of liquidity. Meaning, like, if I walk in and I see a garden that's growing out of control, I know it's been watered well. You know what I mean? Like, so when I look at a market that is run like that for 15 years with no significant, people like COVID, and I'm like, yeah, but again, the impact,
COVID was the point because that was when they came in and said no one can
go
be allowed to go default on anything.
Right.
Yeah, you can't kick anyone out of houses, like nothing.
Right.
Everyone went. Surprise.
Yeah. COVID was a triple down on those kinds of policies. Right. And so guys, just believe me, don't believe me. Human nature doesn't change. You've got a record level of fraud. And I think that Chanos will eventually be, I feel virtually certain that he's going to be proven correct, that this will be looked back as the golden age of fraud.
Yep.
And here's the thing. When the tide does go out, there's going to be people and companies wrapped up in this fraud that nobody saw coming.
Right.
There's going to be big players
that go
down.
that we drop our jaws to,
yeah,
even though we're sitting here talking about it ahead of time.
Yep. So, yeah. Anyway, the one thing I will say is if people out there are invested in any of the stuff that we're invested in, I do think these are one of those moments where discipline on portfolio management really comes in, right? Don't be afraid to take some profits. The other thing I will say though, is that one of the things that is difficult about our portfolio right now, and I say all this in a good way because we're having a heck of a year, One of the tough parts is the valuations, because on a comparable basis, even though we've run so lot, we've still got a portfolio that is valued well south of the overall market. But so I don't think anybody should, if you own some of those things like we do, I don't think that you should have long-term concerns. But we also know the markets don't go straight up into the right. They don't go one directional. And so, if nothing else, I think that this could be a good advantage. Again, nobody knows the short-term market moves, but I know the way that we're going to be playing it is just staying disciplined and trimming the bushes when they get too big, and stacking up, money for a pullback.
Yeah, I mean,
it's the only thing to do, in my opinion.
There's a lot of dried wood at the moment, so it does feel like you could get a little bit of a. It doesn't take much to spark a fire at some point. Now, it's hard for anything to happen really until you get enough downside to start the engines on CTAs and stuff having to sell. Then it will all be clear.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
Another thing I think I've talked about a little bit, and I know we've at least definitely talked about internally, is just the liquidity problem just inside of. Now, maybe they come out Wednesday and they completely end QT or whatever. My opinion is they really need to do that now. You look at bank reserves. Bank reserves are like really starting to get low. They think they got room to keep going there, but we still have like another like $200 billion to go on refilling the TGA. You're starting to see repo rates get a little squirrely here in the last week or two. Like there's just a lot of little small like yellow lights flashing to say like, hey, a little liquidity problem could be here soon.
And seasonality is really bad, and retail is max bullish.
So speaking of retail, speaking of seasonality bad, I think a lot of people are like, oh, August, early September can be.
October's the worst.
Well, the from now until the end of September is the worst the worst 2 week period.
Yeah.
And if you think about it, today is the corporate income tax day, where a lot of people have to send money in, which again, that's a liquidity problem. That's money leaving private hands to go public. So that is a liquidity drain by definition. So like there's a lot of these little liquidity like clusters that all of a sudden are hitting. No one's noticing, no one's caring. The market's acting like it's the opposite. I think it's because global liquidity is so good because China's making it rain and stuff. So domestic liquidity might be way worse than it looks, and we may wake up one day with some crazy repo rate spike or whatever, and the market's like, wait, what? I don't know. It's just something to keep in mind for people.
Yeah, I mean, part of it's probably because you and I are wired like that, but just in finance, I mean, it's always that same thing. When you see a lot of exuberance and extreme bullishness without the underlying, things accompanying it that you would think would drive such sentiment, that's always when things are bad or about ready to happen.
And I've often referred to the Fed as being a 3-month moving average of the data, so they're always just kind of like late and focused on the rearview mirror. I think earnings expectations they do the same thing. So if you remember back, call it 3 months ago, I was saying like, hey, I think earnings expectations are too low now. I think they're actually going to bounce. Well, they've bounced a lot since then, and that's a big reason the market's ripped. Is like, hey, well, earnings expectations keep going higher. But if you think about it, you had the Liberation Day thing, which plunged markets, plunged what everyone thought was about to happen to the economy. So everyone extrapolated that. You had people pull guidance, lower guidance. Well, next thing you know, like they're saying, just kidding, like we're going to chill out on that stuff. So everything comes ripping back asset price wise. Earnings expectations pick back up. People reinstate guidance. They raise guidance. The AI bubble comes back and everyone's happy. But now I'm looking at it. I'm like, all right, cool. Like we got those earnings expectations way up. Now I'm looking at the economy, the real economy. I'm like, well,
yeah.
Now the tariffs are actually starting to take bites out of stuff. People are letting workers go because of it. Like, so now I'm looking at those earnings expectations. I'm like, ooh, those may need to start rolling back over. So it's almost like that same 3-month moving average thing for earnings expectations, where it's like, okay, you're right looking back 3 months, but looking forward 3 months, I don't know, man.
Yeah, this definitely feels like one of those moments where you're just a little too far out over the skis.
And it's like everything too. Like it's hard to find a chart not going pretty straight up at the moment.
Oh, especially a lot of the stuff that we own,
Yeah.
which is fun. Look, I'm not griping.
No.
I'm just saying it, now the flip side is, like I said, what makes me feel a lot more comfortable because, I mean, and this still doesn't mean that we're not going to see some short-term volatility in these names. But if you go through our book and our positions, you look at the underlying valuations, even after these things have run, they're still not expensive.
No.
Like even American Eagle, we're up. I think we've doubled our money on that, right?
I don't think so, but it's done well.
I thought we bought it right around 10.
No, I think it was higher than that. I think that was before that it jumped that 25%.
Oh yeah, we got it like around 11.50
So I think we're
or
probably
something
up
like that.
60,
Okay,
something
okay,
like that.
yeah. I think it's more than 60, but I think we got it in the 11s, or it could be in the 12s. Yeah.
Anyway.
But yeah, but even that, you look at that, I still like that bet. The things, even after this run, it's trading at 18 times earnings and we're getting paid 4.5% a year on the dividend. I mean, that's not, and there's an earnings inflection going on there too, right?
Yeah.
Same with the gold miners, same with China.
Right. None of that stuff's expensive. And we talked about this in our morning meeting today. So basically, we have a lot of stuff in the portfolio, but when it comes to size, it comes down to essentially Google, gold miners, China, Asia mix as kind of the key tenants, right?
Yeah.
And some energy stuff.
Yep.
If you were to chart any of that against the S&P, none of it says ooh, this is riding high.
No,
if you chart it by itself, you're like, ooh, you should get out of that.
Yeah,
if you chart it versus the S&P, it's barely moved.
Yeah, well, that's the thing, and that's the one thing that we were talking about too, where I'm like, yeah, do I get nervous when it's working too well? Yes, but then it is important, I think, to take a step back and put things back in context. These things that we're holding that are outperforming the market on a relative basis have underperformed for their longest period of time in history, most of them. Right. So when you look at it on a relative performance chart, this a violent up move, and you pointed this out this morning, this violent up move that's making both you and I nervous, it looks like it's like a Major League Baseball team having a really long drought and not getting a hit, and someone just hit a really solid foul ball, right? Meaning, yeah, it's improving, but when you put it into context, if you get reversion to the mean on that trade, this thing's in the first inning.
Yeah. I mean, China's now beat the US for 2 years. It's up almost 50% this year. But if you chart it against the S&P, you could argue it's just starting to break out.
Yeah.
And the same goes for all world ex-US.
And it's trading
gold miners.
And it's trading at half the valuation in an earnings trough versus the S&P, which is at record earnings.
Yeah.
And remember, I want to own the S&P. No. You want to own you want to own the stuff that's about to do good, not the stuff that did. Right? That's the mistake. It's a mistake everybody makes. When we're buying something that looks cheap and it's in an earnings trough, that's when we get interested. Right? Now, sometimes they don't come out of those earnings troughs. That's
or it takes a long time.
Yeah. And that's where the whole value of the catalyst thing comes in.
Yeah,
right?
Yeah.
Anyway, you got anything else to add here?
No, good.
Yep. I just think, a little discipline, stay disciplined, harvest some profits.
Yeah, get out the hedge trimmers and do a little bit of work there.
I know, but I've gotten emotionally married to some of these positions.
That's when you definitely know you should trim a little more.
I'm not emotionally married, but you know what I mean?
I get there. I know Pat gets there.
What are you talking about? I had to go.
We talked about that this morning.
Yeah.
I get there for sure.
Yeah. No, just you get into, and that can be a good thing. I don't think it's a bad thing as long as you're aware of it.
It's a double-edged sword.
Yep. All right, you guys. Thanks for joining us. As always, we will be back again tomorrow. Follow us on Twitter. I'm at KYR Radio. Chase is at Pinecone Macro. On YouTube, just search Know Your Risk Podcast and invite your friends, man. Right? And then check out the interview we did. I did an interview with a really special human being to me. It was ex-football coach who played in the NFL and was a great example to me when I was in high school, like a big brother. And then he's become a very successful man in his own right and runs an extraordinary executive coaching business and leadership business. And he's written several books. And he's one of the people that has taught me the most and helped me build Bulwark. And not a brag, I wake up every day like shocked that I get to live the life I live. I really do. I feel like very undeserving. But so much of it is primarily due to God's good grace. But so much of it has been the stuff that he taught me, right? The accountability and the practices and the organization, and so much of that stuff. And when something radically changes your life like that, you want to share it with people, and especially for kids starting out. If you got college kids, have them listen to that, not to hear what I say, to hear what he says, because it works, and I'm proof. And I know he's improved a lot of people's lives. But yeah, it's a good one. So anyway, that being said, we got to go. Have a wonderful evening, and we'll see you tomorrow. You're listening to Know Your Risk Podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.